Vail Resorts is a fairly interesting stock. It operates different ski areas and mountain resorts, and historically it has been a fantastic compounder. Sure, they dipped during COVID, but other than that, they have just been compounding ever since the financial crisis. Well, recently the stock has dropped quite a lot and it's down nearly 50%. And the stock is paying a 5% dividend, so is this maybe a buy? Let's look into it. First of all, we can see revenue, fantastic growth over time. In the last few quarters, it has kind of stagnated, but we will look into that in their earnings report. They have started buying back some shares, but overall, over the years, they're mostly flat. Free cash flow, also just like revenue, slightly down, but it is starting to recover, so maybe we already see the plateau here. And of course, this nice dividend, they have stopped raising it recently as fast, because now free cash flow is kind of down. They don't want to pay out more than they get it. Now, what is one risk with this company here? This debt. They have $2.9 billion in debt. On currently $400 million of free cash flow. Now, how did they get into that debt? Mostly acquisitions. We can see they have gone on a spree of acquisitions from 2015 to 2022. They have bought a lot of resorts. This is how they got that amazing growth. And here we see a reason why their revenue is currently not growing. They had huge weather issues, so of course that affects the ski season. But I would say that is just temporary. They have all these resorts, and you can't just plop another resort down next to it. There is no other mountain there. And if there's another mountain close to it, which would be suitable, why would you build another resort there? There's one right next door. It is gonna be not effective to compete with them. So they have a huge moat. They're basically indestructible. The only thing that can disrupt them is the weather and spending. And now you gotta think, of course, skiing, a bit more expensive, and we have a softer economy right now, not as much money in the pockets of people, so of course skiing is gonna be affected. Plus the unusually bad weather, and revenue is not declining, so I think that is very strong here. Plus, they don't only have the skis resort. If you think about it, they own the mountain. They have an entire resort. And you don't only have the ski passes there. If you're on that mountain, you're not going down. You're probably gonna get a hotel there, you're probably gonna eat there, you're probably gonna buy there, and they own all of that there. They can either rent it out or do it themselves. And that is a big part of their business. They're also renting out ski gear and stuff like that. So they're also making money from the people who buy the pass, go there, and just spend money there. But at the same time, they're also going from the lift tickets, which is basically like the one-time tickets you buy. You go there for like a week or two. More to people buying passes, which you can basically imagine as subscription. And they have achieved a high growth rate there. That is regular income that they get. People are less likely to cancel those. We can see they have a higher return rate. They're gonna eat more there. They're gonna spend more money there. Vail is gonna make more money. They have kind of decided to lower their margins a bit to grow their customer base. We can see they're only now just back to prices from 2021. But overall, I expect them to grow that at a higher rate. So even if they don't attract more people or build more resorts, they have this good pricing power. And it works. And when we look at where they're positioned, they're kind of only positioned in the US right now. Sure, they have a few spots somewhere else, but especially Europe, they have huge amount of growth left. Europe is the biggest skiing market in the world, and they have basically no presence there. They're currently buying some there, but I would say they still have way more room to grow. So do I think the stopping in revenue growth is temporary? Yes, I think once the weather starts getting better and the prices of their ski passes slowly return to normal, this revenue is gonna start to grow again, especially because they are just coming out of investment phase. You can see they spent a huge amount of money here on capital expenditures. That's why free cash flow is slowly starting to return. Now, of course, it's still kind of artificially low, but I think soon the operating cash flow will pick back up, and I see no reason why they wouldn't be able to hit around 18% margin, which they were doing consistently in around 2017 and around. I don't think they're gonna reach the higher levels of 2022. If they do, that's great, that's a great upside, but I think the downside on this company is very limited. You have a huge moat, you have a good growth path. Now, if we assume they're gonna get to their free cash flow margin of 18%, they would make a free cash flow per share of 13.68. Historically, they have grown at around 15%. I want to keep that a bit lower. Revenue growth of 10%, share buybacks of 2%. They're currently not buying back many shares. Once the free cash flow picks back up, I think they're going to be able to buy back some more shares. I don't want them to take on leverage to buy more shares. I like that the debt is staying flat right now with low free cash flow. So 12% for the next 5 years, 10% afterwards, little slowdown. 16 multiple, it is a fantastic business. It has a great moat, so I think this deserves a slightly higher premium. Payout ratio of around 60% with a little deduction due to taxes. Intrinsic value per share of $297. Currently trading at $177. That's a 68% upside. Now, what if it goes better? They return back to normal growth rates, 15%, 12% afterwards, and an 18 multiple, because you know, the business is fast growing. $391 a share. So, fantastic upside there. And even if it goes a bit worse, let's say the weather due to climate change stays worse. 8% growth rate, 6% after that, 14 multiple because slower growing company. $202 a share. We still make over a 10% return. So I'm seriously considering adding Vail to my portfolio. I might do it once I put more cash into my portfolio next time. I think it's a fantastic company with a great moat, currently trading at a suppressed price. What do you think? Write it down below. Have a good day.